Welcome to the deep dive. Today we are opening what feels like a literal time capsule.
It really is.
We're looking at documents that contain some of the most critical investment principles ever devised. And we are not talking about the sprawling, the familiar story of Berkshire Hathaway.
No, not at all. We're going way back.
We are going back to the very beginning.
Yeah.
We're going to be examining the private, almost forensic documents of the Buffett partnership letters from 1956 all the way through 1970.
And this is the intellectual blueprint. I mean, what we're looking at here is the 14-year period where Warren Buffett engineered a staggering 29.5% annual compounded return. And that's gross of fees.
Which is just an unbelievable number.
It's astronomical. And you have to put it in context. In the context of the S&P 500 at the time, this represents one of the highest sustained periods of true investment alpha in history.
So our mission today is not just to summarize these letters. I mean, anyone can do that. We want to extract the DNA of that success.
Yeah, the real mechanics.
The real mechanics. We need to understand his initial ground rules, which, they really function as a kind of behavioral contract with his investors. We need to get into the specific investment mechanics he mastered, the workouts, the control situations.
And of course, that critical philosophical shift, the move from deep liquidation value to appreciating franchise value.
Exactly. We're looking for the precise valuation math and, maybe more importantly, the psychological architecture that supported nearly 3 decades of, unrivaled performance.
Okay, and before we dive into all that methodology and the numbers, we do have to start with the necessary standard declaration. It's important.
Of course.
All the analysis we're discussing today is based on publicly available sources. It may be subject to revisions or, differing interpretations. This content is for educational purposes only, and it absolutely does not constitute investment advice.
You have to do your own homework.
You must conduct your own due diligence before making any investment decisions. Okay, with that out of the way.
Let's get into it. So Section 1. Let's set the stage. The year is 1956, and it's a moment of really a radical transition in the investing world.
It is. Benjamin Graham, who is the father of value investing, Buffett's mentor, he had just closed shop. He liquidated Graham-Newman Corporation and retired. So there's this vacuum.
And Buffett returns to Omaha, not to launch some massive Wall Street fund, but to manage capital for a very, very small circle of people.
It was incredibly personal. I mean, it was intimate. He started the partnership with just a modest $105,000.
Wow.
And most of that, the bulk of it, came from 7 limited partners. We're talking family and friends. Buffett himself only put in $100.
$100? That's amazing.
Yeah. And this humble beginning, it really meant that the rules he set up were less about mass marketing and more about establishing a really strict long-term philosophical commitment.
And what's so fascinating to me is that right from the very start, he identified the single biggest threat to long-term compounding. And it wasn't a recession. It wasn't a bear market.
No, it was human nature. He got it.
He understood that markets are volatile. But what really kills you is investor emotions.
Fear, greed, impatience. They are guaranteed profit destroyers. He knew that. And those initial letters, especially that annual section he dedicated to the ground rules, they weren't just letters. They were a behavioral contract.
A contract. That's the perfect word for it.
Their primary purpose was to filter his investor base. He wanted to ensure that only people with the right temperament and, crucially, the right time horizon were even allowed to stay in the partnership.
So he was engineering rationality right into the foundation of the business, setting very clear expectations. Let's dive into those foundational rules, the immutable laws of the partnership.
Okay, so rule number 1 had to deal with expectations. It was simple, no guaranteed return.
Which seems obvious for an equity fund today, but maybe not back then.
Not at all. In the mid-50s, a lot of investors expected stable, almost bond-like returns from any kind of pooled capital. So Buffett had to be crystal clear. This is a risk equity partnership. By explicitly stating, and I'm quoting here, in no sense is any rate of return guaranteed to partners, he was managing their downside expectations.
He was preparing them for the ride.
Exactly, preparing them for the volatility that is just inherent in buying deep value stocks.
And that one rule probably saved him from 1,000 panicked phone calls during the first market correction.
Oh, absolutely. But then he introduced an even more subtle piece of genius. It was about how performance would even be measured.
The relative performance benchmarking.
Yes, success was not about whether they were up or down in absolute terms. It was about how much they outperformed the broad market, specifically the Dow Jones Industrial Average.
He was basically introducing the concept of alpha before it was a buzzword.
He was. I mean, before that term was widely used in quantitative finance. For example, he explained that if the BPL was down 10% in a year, but the Dow was down 20%, that was a fantastic outcome.
Right, because you preserved capital relative to the alternative.
And that fundamentally trained his LPs, his partners, to think in terms of opportunity cost and survival, not just in terms of absolute dollar gains.
I really appreciate that focus because it just shifts the entire psychological framework. If your benchmark is simply to beat the market, you're just so much less likely to panic when the market itself crashes.
Of course, you're just comparing your performance to the next best alternative. It externalizes the blame for a bad year away from the manager and onto the broader market environment, as long as the manager still generated that positive alpha. It's a very sophisticated defense mechanism.
Okay, rule 3 is vintage Buffett. It's something he still talks about today. No forecasting.
Yeah, he just flatly rejected the prevailing idea that to be a successful investor, you had to predict next quarter's GDP or, the next big geopolitical event.
This was a really radical rejection of the macro approach, which I have to imagine dominated Wall Street in the 1950s.
Oh, it did. And Buffett stated, "I am not in the business of predicting general stock market or business fluctuations." He saw market timing and macroeconomic predictions as a profound distraction.
A waste of time.
A total waste of time. His entire focus was microscopic. The valuation of a specific company, its assets, its management, its intrinsic value, and all of that was independent of whether the Federal Reserve was going to raise rates next month.
It's a statement of humility, really, but it's also a statement of efficiency. Why waste your time on impossible predictions when you could focus 100% on analyzing verifiable facts about specific businesses?
Precisely. His work was proprietary analysis, not proprietary guessing. He knew the only enduring competitive advantage he had was in the depth of his microeconomic analysis.
If he's focused on macro, he's just another guy with an opinion.
Right. He's competing with millions of other people and all their opinions. But by focusing on the micro, he could find true informational and, valuation asymmetries. He could find things others missed.
And finally, the ultimate defense mechanism against the impatient partner. He demanded patience, the time horizon.
This might be the single most important ground rule for anyone listening who wants to achieve compounded returns. He wrote, and this is a great quote, "While I much prefer a 5-year test, I feel 3 years is an absolute minimum for judging performance."
3 years? Why 3 years specifically? What was the logic there?
Well, because these deeply undervalued securities, the cigar butts he was buying, they often take a long, long time for a market catalyst to materialize and, for the price to re-rate.
So the value's there, but the market just hasn't noticed it yet.
Exactly. If he was buying a stock that was trading at half its liquidation value, that gap might take 6 months to close. It might take 3 years or even 5 years. So by locking his LPs into this time frame, he gave himself the necessary runway to execute his arbitrage spreads and his activist plays without facing emotional pressure.
Or redemption requests.
Or redemption requests driven by a bad 6-month period. It protected the long-term compounding machine from short-term emotional interference, which is, that's the very definition of good behavioral finance.
It's just remarkable that he recognized that the hardest part of his job wasn't finding the undervalued stock. It was managing the emotions of the people who trusted him with their money.
It is a profound psychological insight, and it informed every single element of the partnership structure, right down to the way he got paid.
Okay, so let's get into that. The ground rules filtered the investors. They set the philosophical tone. Now we move to the financial architecture, the fee structure. This is where he engineered his incentives to be completely, brutally aligned with his partner's success. And it's a model that is still radical today.
Oh, it was an absolute masterclass in alignment. And it stands in stark opposition to the modern 2-and-20 hedge fund model, where, managers get paid lavishly just for collecting assets.
Let's start with the most shocking detail, especially for an investment partnership in the 1960s, the 0% management fee.
Just think about the depth of that commitment for a second. He took no salary. He took zero fee on assets under management, or AUM. Zero. Zero. This meant that if he raised, say, $500 million and decided to just put it all in low-yielding cash or treasury bills, he earned $0.
He had only one path to getting wealthy.
Only one, generating profit for his partners. This fundamentally eliminated the incentive to prioritize asset gathering over asset performance.
And that right there differentiates him from almost every professional manager operating today. I mean, so many of them prioritize maximizing AUM because that 2% management fee is their guaranteed revenue stream, performance or not.
Exactly. Buffett guaranteed that his income was purely performance-driven, and that created enormous pressure on himself to deliver alpha year after year after year.
So if he wasn't charging a management fee, how do you get paid? That's through the hurdle rate and incentive structure, which it matured into a standard model by about 1962.
This is where the mathematical alignment becomes really tight. The partnership featured a very substantial hurdle rate. The first 6% of gains went entirely to the limited partners, the LPs.
All of it.
All of it. Buffett only earned his incentive fee, which was 25% on profits above that 6% hurdle.
6% sounds modest today, but in the environment of the 50s and 60s, that was a very respectable return. That was akin to what high-quality bonds were yielding.
It was. So his partners were essentially guaranteed the safe, sensible return first. They got the risk-free rate plus a premium before Buffett ever saw a dime.
But the detail that ensured absolute, almost painful alignment was the loss carry forward. This is essential to understand, right?
Oh, it's the whole ballgame.
So explain that mechanism. What was the psychological impact of it?
Okay, so if the partnership failed to hit that 6% hurdle in a given year, or if it actually lost money, that deficiency, the shortfall, was carried forward to the following years.
It followed him.
It followed him. Buffett could not earn a single cent in incentive fees until two things happened. First, the partners had to be made whole on any prior losses. And second, the partnership had to clear the 6% hurdle on the new gains.
So let's run a hypothetical. If they lost 10% in year one.
Right. Then in year two, the partners needed to gain that 10% back plus another 6%. So a 16% total gain in year two before Buffett could even begin to participate in the upside.
That is just brutal accountability.
It is. It dramatically increased his own personal income volatility, but in doing so, it provided the strongest possible guarantee to his partners that he was totally focused on capital preservation and long-term compounding.
So the economic implication here is what?
Well, this structure, it effectively turned Buffett into a highly leveraged equity holder in his own fund. But it was a special kind of leverage that only worked if the returns were spectacular and, just as importantly, sustained over time.
You know, we should reflect on the historical context. Was this loss carry forward structure common in the 1960s, or was this genuinely a radical idea?
It was extremely rare, particularly among investment managers who were developing a public reputation. Most managers were focused on maximizing that immediate guaranteed management fee.
Easy money.
The easy money. Buffett was essentially saying, I am so confident in my ability to generate alpha above the 6% hurdle that I am willing to go without any income during the bad years. That was a bold and defining characteristic of the partnership.
And that level of alignment is cemented by the commitment he made in the 1962 letter, the one about his personal investments.
Yes. That 1962 commitment is the very definition of skin in the game. He explicitly inserted a provision prohibiting himself and his family from buying any marketable securities outside the partnership.
Not at all.
He stated that the partnership would represent his entire investment operation, ensuring that his financial results would be directly proportional to his partner's results.
So he completely removed any temptation or possibility of a conflict of interest. He could never make a better investment for himself outside the fund.
And that reinforces the whole behavioral contract. He was putting his money not just where his mouth was, but where his mind was.
And that transparency, that commitment, it was necessary because the methods he was about to employ, deep value, special situations, activism, they were complex. They required immense trust from his limited partners.
Absolutely. He needed them to know, without a shadow of a doubt, that their financial fate was inextricably tied to his own.
Okay, so with the contract set, the investing machine starts running. The late 1950s were crucial for establishing the partnership's credibility. And 1957, in particular, provided the first major stress test right after inception.
Yes, 1957 was the empirical validation that his defensive philosophy worked, and it worked immediately. The Dow declined 8.4% that year. That's a significant correction.
And the Buffett partnership
Achieved a positive return of plus 10.4%.
Wow, a differential of nearly 19 percentage points in a down market. That is immediate proof that his value-based security selection offered genuine protection against broad market sentiment.
It confirmed the resilience. He wasn't just buying cheap. He was buying things so cheap that they had what Graham called the margin of safety, and that allowed them to withstand broad market pessimism.
I think the clearest way to understand this early process is through the case studies he shared. Let's focus on Commonwealth Trust Co. This seems like the quintessential cigar butt investment.
It really was. This was BPL's largest early holding. It comprised a substantial portion, sometimes 10% to 20%, of their total assets. Commonwealth Trust of Union City, New Jersey, it just perfectly illustrated the value disconnect he was looking for.
So what was the core valuation math? Why was this, as he saw it, a $125 stock that was trading for only $50?
Well, based on the bank's underlying assets and its very conservative, consistent earnings power, Buffett calculated the intrinsic value at $125 per share.
Okay.
But the market price was hovering around $50 per share. That is a 60% discount, an enormous disparity that immediately appealed to him.
And the reason for that huge discount was purely behavioral, right?
Yeah.
It wasn't because the business was failing.
Not at all. The company was well managed. It had earnings of about $10 per share, which means at a $50 price, the stock yielded a 20% earnings yield.
20%.
20%. However, the bank paid no cash dividend.
There's the catch.
And for the typical retail investor of that era, a stock that didn't pay a dividend was considered dormant or, dead money. They completely ignored the fact that the bank was reinvesting that $10 per share, making the intrinsic value compound internally.
So Buffett wasn't looking for a cash payout. He was looking for that very high rate of return on the capital he invested, that 20% earnings yield, with the ultimate expectation that the market would eventually recognize the true value.
And he added two defensive characteristics to the thesis. First, the bank was fundamentally stable. That minimized the risk of any permanent capital loss. Second, there was a clear, though maybe delayed, catalyst.
What was it?
A larger bank already owned 25.5% of the shares and was very keen on acquiring the rest. So this was a classic value play. Buy something worth much more than its price and wait for external events to close the gap.
But the truly instructive lesson in discipline comes with the exit. Buffett and the partnership, they accumulated about 12% of the bank, and then he sold the entire stake at $80 per share.
And this is where the conversation gets really interesting. I mean, many investors might scratch their heads and ask, why would you sell at $80 when your own intrinsic value calculation was $125? You're leaving $45 per share on the table.
And the answer, of course, lies in his relentless focus on opportunity cost.
Absolutely. The decision wasn't based on maximizing the profit on Commonwealth. It was based on maximizing the compounded returns of the entire partnership portfolio. He sold at $80 because he had identified a special situation, which we now know was Sanborn Map, where he could deploy that capital and achieve an even higher expected rate of return, and crucially, gain control.
So the lesson there is that your capital must always flow to the most fertile ground, even if that means exiting a profitable position before it hits its ultimate valuation peak.
It's the definition of a rational, non-emotional portfolio management decision. I mean, if you find a security that offers a 30% annualized return with high certainty, you sell the security that offers a 15% annualized return with the same certainty, even if that 15% security is still deeply undervalued.
Okay, so as the market rallied into 1959, the Dow was up 20% that year. Buffett noted a pretty worrying trend in his letters.
He did. He observed that the rising tide was drying up the opportunity pool. He stated that the Dow, while rising, presented a somewhat faulty picture, and that as the overall market level increased, the number of undervalued securities was just diminishing.
The easy pickings were gone.
They were gone. The traditional Grahamite approach was becoming much harder to execute because prices were starting to rationally reflect value.
And this scarcity, this lack of opportunity, it forced his first major strategic pivot, the shift from being a passive value buyer to an active value creator. He decided to, and this is his phrase, create my own workouts.
This is the critical transition point into activism. You see, merger arbitrage or workouts relies on the market providing the catalyst. When the market failed to provide these low-risk, high-return situations, Buffett's solution was to acquire such a large position in a company that he could force the corporate action himself.
So he wasn't waiting for the catalyst, he was the catalyst.
He was the catalyst. And that generates an idiosyncratic return stream that's independent of the overall market beta. This ability to create value, rather than just wait for it, is what truly defines his alpha generation in the 1960s. He referenced the 25% holding he had accumulated, which was virtually assured of a performance better than that of the Dow Jones for the period we hold it, and that was setting the stage for the control situations that followed.
Okay, so the new decade sees the partnership fully embrace activism.
Cool.
1960 was another down year for the market. The Dow fell 6.2%, and yet the BPL delivered a colossal 22.8% return.
That differential is pure manufactured alpha.
And the primary engine of that outperformance was the Sanborn Map Company, the realization of that control situation he had foreshadowed in 1959. This case study is just crucial for understanding how he unlocked value both legally and technically.
Absolutely.
So what was the inherent disconnect at Sanborn? What was the opportunity?
Well, Sanborn's core business was producing these really detailed fire insurance maps. But this was a legacy business. It was rapidly declining. It was generating less than $100,000 in operating profit.
So the market sees that, sees the declining operations, and prices the stock accordingly.
Right. But the hidden value was the massive accumulated investment portfolio on their balance sheet. That's what everyone was missing.
And how much was that portfolio worth compared to the stock price?
The investment portfolio, we're talking high-quality bonds and stocks, was worth approximately $65 per share, yet the stock was trading at just $45 per share.
So the market was pricing the failing map business at a negative $20 per share.
Which is an absurd distortion. The declining operations were completely overshadowing these highly valuable liquid assets.
So how did the control mechanism work in practice to close that $20 gap? I mean, it wasn't just buying shares and waiting around.
No, it required taking an active, controlling role. Buffett and the partnership acquired around 35% of the outstanding shares. Then they allied with other dissatisfied shareholders, which allowed them to gain control of the board.
And once they had fiduciary control, the strategy was simple but ruthless.
It was. Separate the valuable asset from the declining operation.
And what was the solution they presented to the other shareholders?
They offered shareholders a choice. They said, you can either keep your share in the residual map business, or you can tender your stock and receive your pro rata portion of the investment portfolio's securities.
So it was essentially an option to liquidate your stake at its fair value.
Precisely. This forced realization instantly unlocked the full value of that $65 per share portfolio. Buffett had manufactured his own arbitrage spread, and in doing so, he reduced his dependence on the market to recognize the value. This was the archetype of a successful control situation.
So buy a business where the intrinsic value far exceeds the market price, and then take the necessary steps to force the liquidation of that hidden value.
That's the playbook.
Okay, so if 1960 was the financial and legal engineering play, 1961 shifted the focus to operational mechanics with Dempster Mill manufacturing. This required an actual operational turnaround.
And 1961 was a huge bull run. The Dow was up 22.4%, but BPL managed an astonishing 45.9% return.
Wow.
Yeah. And Dempster was a much harder challenge. It was a farm equipment manufacturer, and it was characterized by a high book value, but really poor profits. And that was because its operations were bloated. Specifically, it was burdened by massive amounts of illiquid, obsolete inventory. This was not a passive investment. It was a full management challenge.
So the critical moment here wasn't a stock purchase. It was a personnel decision.
Installing the right leadership was absolutely crucial. Buffett brought in a manager named Harry Bottle, and Bottle had a singular mandate: aggressively liquidate that bloated inventory to convert those assets into cash.
And he did.
He did. Bottle streamlined operations and generated significant working capital almost immediately.
And what did Buffett do with that cash? He took this brilliant sort of counterintuitive step.
Instead of just returning the cash to shareholders, Buffett realized the ultimate upside was to deploy it intelligently. So he used the cash generated by the operational turnaround to invest in marketable securities within the Dempster corporate entity.
Hold on. So Dempster Mill went from a struggling farm equipment manufacturer to basically an investment company funded by the profits of its own liquidation.
Exactly. This is the ultimate example of value recycling. The stock, which BPL bought for around $18 per share, was eventually liquidated at over $80 per share.
So what did Dempster prove?
It proved two things. First, that Buffett could successfully implement operational turnarounds. He wasn't just a stock picker. And second, that the value of assets could be instantly improved by putting them under better management and in a better format, in this case, investment holdings. This was a potent combination of Graham's value hunting and the principles of, well, operational private equity.
And the entire ethos of this activist period is really summed up in the patience moral he included in the 1961 letter. He's reinforcing those initial ground rules.
He is. He wrote, "Our business is one requiring patience. It is to our advantage to have securities do nothing price-wise for months or perhaps years while we are buying them." And that just reminds the LPs that volatility is good when you're accumulating and that waiting for the market to reflect intrinsic value is a necessary and profitable part of the process.
Okay, so the early 60s see the partnership strategically mature. 1962 provided yet another critical defensive test. It's often called the Kennedy slide, where the Dow fell 7.6%.
That correction was severe, but BPL delivered a solid positive return of plus 13.9%. This sustained defensive alpha, even during stress, it just validated his balanced approach between general stocks and the workout and control situations.
He actually quantified his defensive target in that 1962 letter, which I think is great for understanding his risk management philosophy.
Yeah, he aimed for minimal loss exposure. He said, "Our target is an approximately 12% decline for each 1% decline in the Dow."
So in a 7.6% drop, his target was to lose only about 3.8%.
Right. And beating that target by delivering a positive 13.9% return just shows the depth of the undervaluation and the margin of safety that was built into his portfolio selections.
The 1962 letter also features these famous historical anecdotes where he drove home the magical power of compounding. Why dedicate so much time to these examples when his returns were already so spectacular?
Because even with great returns, people forget the long-term perspective. They panic. These anecdotes were pedagogical tools. They were designed to maintain that psychological contract with his partners, reminding them that the compounding machine works exponentially, even with seemingly small differences in the rate of return.
Let's look at his examples because they're so memorable. He discussed Queen Isabella funding Columbus.
He did. He estimated her initial investment at roughly $30,000, and he calculated that compounded at just 4% annually until today, that investment would be worth an estimated $2 trillion. He used that to show the immense power of time.
He also used the example of Francis Bent's buying the Mona Lisa.
Right. Francis I paid around $20,000 for the painting in 1540. And Buffett posited that if that money had been invested instead at a steady 6% rate, the value today would be measured in the quadrillions of dollars.
Quadrillions.
The simple moral is that a small, consistent rate of compounding over centuries produces outcomes that just defy human intuition.
And the most famous example, of course, the 1626 purchase of Manhattan Island.
Peter Minuit purchased Manhattan for the equivalent of $24. Now, if that $24 had compounded at 6.5% annually, it would be worth $42 billion today.
Which is an incredible number.
But here's the punchline that Buffett delivered. He said if they got a half-point better 7%, they'd have $205 billion. The tiny fractional difference between 6.5% and 7% resulted in a five-fold difference in the terminal value over that long period.
So the implication for the partnership was clear.
It was. Every basis point of alpha he generated now was disproportionately important to the final wealth of his limited partners decades down the road.
This philosophical grounding prepared the partners for what I think is the most significant intellectual pivot of the entire partnership era, the 1963 investment in American Express. This is where he moves from Graham's cigar butt to franchise value.
This transition is monumental. I mean, Graham believed that true safety was found in assets you could liquidate, the physical land, the inventory. American Express was the opposite. It was a high-quality brand facing a massive existential crisis because of the salad oil scandal.
Can you explain that crisis and why it threatened Amex's entire financial structure?
Sure. The crisis involved a company called Allied Crude Vegetable Oil Refining Corporation, and they swindle Amex's warehousing subsidiary. Allied Crude filled these giant storage tanks with water, but put just a surface layer of oil on top.
So it looked like they were full of oil.
Exactly. And Amex, as the guarantor, issued fraudulent warehouse receipts based on this. The liabilities were massive, and for a time they were feared to be unlimited. The stock just crashed.
A quantitative value investor, following Graham strictly, would have seen the balance sheet hemorrhage and concluded the company was permanently impaired. They would have run away.
Absolutely. But Buffett looked beyond the ledger. He performed qualitative due diligence. He focused on the enduring franchise. He didn't just read financial reports. He went out and visited restaurants, banks, travel agencies.
Boots on the ground.
He verified anecdotally that despite this massive scandal in the headlines, customers were still using the green card, and more importantly, travelers were still buying the traveler's checks.
He recognized that the business's true asset wasn't its warehouse receipts, it was the trust in the brand.
That's the insight. The business moat, the trust that customers had in the brand, and the utility of the product was completely intact. The scandal was a temporary financial disaster and a reputational hit, for sure, But it wasn't a fatal flaw in the business model itself.
The business was built on paper and trust, and the trust held.
The trust held. And this conviction allowed BPL to make an extremely concentrated bet. He deployed an incredible 40% of the partnership's assets into American Express at around $35 per share.
40%. That is conviction.
It speaks to the depth of his belief in that qualitative moat. This was a great business at a fair price, purchased because of a temporary panic. And the investment paid off spectacularly. It cemented the philosophical shift. Enduring business quality can often outweigh temporary financial distress. This was the moment he fused Grahamite pricing discipline with Philip Fisher's appreciation for business quality.
Okay, so by the end of the 1960s, the partnership had achieved historical success. But the market environment, as you've hinted, had warped beyond all recognition. The market was dominated by speculative fever.
We were at the height of the Nifty 50 era. Institutional money was just piling into high-growth stocks regardless of price. It created these massive, unsustainable valuations. The market was completely focused on short-term momentum, not underlying value. The go-go fund managers were considered heroes.
And for a value investor dedicated to quantitative metrics, this environment was poison, which led to this extraordinary principled decision to dissolve the partnership, which he articulated in the May 29, 1969 retirement letter.
This letter is maybe the greatest testament to his fiduciary standard. He chose to walk away from guaranteed millions in management fees because his methodology was no longer viable in that specific environment. And he laid out 3 crystal clear reasons for the dissolution.
Okay, reason 1. The opportunities for quantitative value had just dried up.
He stated it unequivocally. He said that the chances for investment open to an analyst who stresses quantitative factors had virtually disappeared. The market was so frothy that the margin of safety required by Graham's principles simply didn't exist anywhere.
The cheap stocks were gone.
They were all gone. He was admitting that even with his talent, he just couldn't find undervalued securities.
Which is a profound moment of humility, but also forensic honesty. The market was only rewarding speculation and momentum, neither of which he practiced.
Right. And then reason 2 was a problem of his own success. The sheer size of the partnership, which had swelled to $100 million.
And that size severely constrained his options.
It did. A small partnership could still deploy capital in small, illiquid, deeply undervalued cigar butts. But you can't move the needle on a $100 million fund with those small situations. He wrote that the size further eliminates a large portion of this seemingly barren investment world.
So liquidity became an active constraint on his ability to generate alpha.
Yeah, he needed to find $100 million opportunities, and they just weren't priced correctly.
And reason 3 was the personal element. He was fundamentally, as he put it, not attuned to the new speculative game.
He recognized that the speculative market was rewarding short-term thinking. He even confessed that he had flunked this test completely during the last 18 months, meaning his conservative methodology failed to generate alpha in that recent hyper-speculative run.
So he knew he couldn't play that game and win.
He knew his natural competitive drive would push him to try and outpace an investment rabbit, and he feared that attempting to do so in a game he fundamentally disliked and didn't understand would risk the capital he had so carefully preserved for his partners.
And that decision to return capital, rather than risk spoiling a decent record, that's the ultimate measure of his fiduciary standard. He chose to close the machine, rather than operate it poorly.
It demonstrated that his commitment was always to the integrity of the process and the safety of the capital, not to maintaining a job title or maximizing immediate fees. He concluded that the only way to stop being competitive in a market he didn't respect was to stop. He literally retired and returned all the capital to his LPs.
And if the May letter was the announcement, the October 9th, 1969 letter was his final sobering economic analysis, confirming just how detached from reality the equity market had become.
He delivered this powerful comparison between the expected returns of passive bonds versus passive stocks. He pointed out that a purely passive investment in high-quality, tax-free bonds would yield about 6.5%, and that was locked up for years. Okay.
He then estimated that the 10-year expectation for corporate stocks as a group was probably not better than 9% overall.
So 9% for stocks sounds great compared to 6.5% for bonds, but the key is the tax implication for the typical partner.
Correct. When you factored in capital gains and income taxes for the average investor of the time, that expected 9% stock return produced an after-tax return roughly equivalent to the passive 6.5% bond return.
So he was essentially telling his partners, who had entrusted him with high alpha managed capital, that the broad stock market had become so expensive that the expected return for owning it passively was the same as owning a high-quality, risk-free municipal bond.
Yes, that is an indictment of market overvaluation. It was a dramatic signal.
For you.
He said that for the average investor, there was little choice between managed stocks and passive bonds. And that signaled the height of the 1960s bubble and perfectly justified his decision to stop playing the game entirely. Okay, so the narrative of the partnership letters is one of intellectual evolution. But the numbers. The numbers are the final, undeniable proof that the system worked. Let's review the statistical legacy over the 13 full years of the partnership.
The data table just confirms this was a period defined by extraordinary, consistent alpha generation, coupled with that defensive resilience we've been talking about.
So over the entire period, the Dow Jones Industrial Average delivered a cumulative return of plus 185.7%.
And the Buffett partnership, using its disciplined approach, generated a cumulative gross return of plus 2,610.6%.
An incredible number.
And even after his generous incentive fees, the limited partners realized a cumulative net return of plus 1,403.5%.
Let's translate that into the metric that truly matters for wealth creation, the annual compounding rate. The Dow compounded at plus 9.1% annually.
The Buffett partnership gross compounded at a stunning plus 29.5%. And the limited partners, net of all fees, compounded at a rate of plus 23.8%.
To sustain that kind of excess return, nearly 15 percentage points of alpha net of fees for over a decade is, statistically, almost impossible.
It is. It speaks not just to his talent, but to the rigid adherence to the behavioral and valuation contracts he established at the very beginning.
And the real measure of the partnership's defensive strength is highlighted in those down years. This is where capital preservation allowed the long-term compounding to truly flourish.
Let's just reemphasize those moments of market stress. In 1957, the Dow was down 8.4%. BPL was up 10.4%.
Incredible.
In the activist year of 1960, the Dow was down 6.2%. BPL generated plus 22.8%. In the Kennedy slide of 1962, the Dow fell 7.6%. BPL was up 13.9%.
And the later 1960s saw extreme volatility. 1966, the Dow suffered a major decline of 15.6%. That would have devastated most investors.
And BPL still delivered plus 20.4%.
Just amazing.
Even in the speculative exit year of 1969, where he was winding down and struggling to find opportunities, the Dow declined 11.6%, and BPL still managed a positive 6.8%. This consistency demonstrates the low volatility nature of the value he purchased. He won by losing less dramatically and then absolutely crushing the market during bull runs with the help of those activist plays and franchise purchases.
So the conclusion here is that the 1956-1970 partnership era wasn't just a successful run, it was a disciplined intellectual journey. He mastered 3 distinct value disciplines in that period.
He did. The liquidation specialist, the operational activist, and finally the franchise investor. And the ultimate proof of the integrity of that entire system was the choice he made in 1969.
To walk away.
To walk away. He proved that his success was rooted in principle, not simply the pursuit of assets or fees. When the rules of the game changed in a way that violated his core fiduciary duty, he returned every single dime. And that integrity is as important as the 29.5% return.
This deep dive into the Buffett partnership letters reveals that unparalleled success isn't magic. It's an engineered outcome. It requires establishing rigid ground rules that govern behavior, creating a radical fee structure that ensures brutal alignment with your capital providers, and maintaining the intellectual flexibility to evolve from cigar butts to enduring business franchises.
The commitment to that long-term view is what made all the alpha possible. I mean, the entire partnership's behavioral framework was built on demanding a 3-year minimum to judge performance. That's a concept that is completely alien to modern finance.
And that leads us to our final provocative thought for you, the listener.
Think about the psychological architecture that Buffett built. We live in a world that is saturated with information, where we track investment returns in minutes, not years. What would happen to your personal investment results, your composure, your conviction, and your long-term compounding if you imposed a mandatory, non-negotiable 3-year evaluation period on yourself?
Would you still be focused on all the daily noise?
Or would you be forced to focus only on the deep, qualitative fundamentals that Buffett demanded of himself and his partners? It's a challenge that is definitely worth adopting for your own financial success.
That focus on underlying business quality over momentary price action is so key. And speaking of tracking the market's temperature from a value-based perspective, to help you understand when the environment might be getting a little too speculative, we do recommend checking out a tool based on many of these foundational principles.
Yes. To track the total market temperature, we encourage you to search for and download the iOS app Buffett Indicator from the Apple App Store. It is a great resource that helps monitor market exuberance. To track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store. Apple Store seller Jesse D. Dubois du Chiadi Bomsi Sola Buffett Indicator
We hope this deep dive into the intellectual genesis of modern value investing has provided you with the historical context and the specific mechanics required to start engineering your own rationality. We'll see you next time.